Friday, January 30th, 2026, and in a few hours, silver lost $26 on screens, while real silver basically vanished. Paper quotes fell from 121 to 95 like an elevator with its cables cut. Gold dropped hard too, 5,600 down near 4,950. If your heart is racing, pause, breathe, stay with me, because the math you are being shown doesn't reconcile with what's happening in the real world. This week alone, silver got crushed, roughly 20+%, one of the nastiest weekly drops in years. Yet at the exact same time, across multiple countries, ordinary people cannot source physical coins and bars. How can the price collapse while the product disappears? In a normal marketplace, lower prices bring more supply and less urgency. Here we're seeing the opposite. So what are we actually trading? By the end of this video, you all understand why the headline chart is not the story, and why reacting emotionally could be the most expensive move you make. Welcome back to Vantage Economics, where we map the hidden mechanics that sit underneath the front page narrative. If you're new, consider subscribing, because this is the kind of breakdown most channels skip. Now, let's rewind. A few days ago, I warned that the area around 117 was a danger zone, based on long cycle behavior that's repeated for decades. So yes, volatility was on the menu. What I didn't expect was a simultaneous failure in the physical pipeline. Major mints stepping back, deliveries failing, and premiums exploding while the chart screamed sell. That contradiction is the clue. Here's the foundation most people miss, and it costs them money. There isn't one silver market. There are two, running in parallel, telling different stories right now. The first is the paper arena: futures, swaps, unallocated accounts, ETF flows, derivatives, numbers in databases traded by banks and large funds, massive volume, lightning speed. But most of that volume never ends with a truck delivering metal. It's largely wagers and offsets. Think of it like a high-stakes scoreboard where points change hands, not necessarily the trophy. The second is the physical arena: minted coins, bars, wholesale blanks, refinery output, and actual deliverable inventory, metal you can hold. In a healthy system, these two arenas connect. Paper quotations approximate physical reality. But right now, that bridge is wobbling. Screens say 95. Shelves say nothing available. Which one should you treat as truth, the quote or the shortage? Let's walk through evidence, because this isn't vibes. Australia, the Perth Mint. Big name, long history, institutional credibility. Before the major dump, while the quote was still near the high teens, they notified distributors that demand had created a serious backlog for a flagship silver coin program, and wholesale ordering would be paused until late February just to catch up. That's not slow sales, that's triage. And they talked about allocations, rationing language. So every region gets some stock. When does a mint ration? When it can't meet pull-through demand. Now ask yourself, if they were strained when silver was expensive, what happens when the quote suddenly looks like a 20% discount? Demand doesn't politely step back. It surges. The drop becomes a flashing sale sign to anyone trying to acquire real ounces. The crash didn't cool the physical market. It poured gasoline on it. Next, the United States Mint. Reports and listings show multiple silver products marked unavailable, suspended, delayed. The public explanation often sounds mundane: pricing updates, system changes. But consider the real constraint. When spot moves violently, a mint can get caught selling at yesterday's pricing while replacement inventory costs far more. If they keep selling, they eat losses. So they pause, reset, and reappear with sharply higher retail pricing. That isn't optional. It's survival. And it's not just the US. India, one of the world's largest silver-consuming regions, has seen dealers unable to fulfill, not running low, but failing to deliver after taking orders. People pay, then get cancellations. That's what a delivery system looks like when upstream supply can't keep pace. If you've never seen it before, it feels impossible, but it's happening. The UK's Royal Mint has also shown outages on basic silver formats: common bars, standard weights. When multiple sovereign mints on different continents display the same stress simultaneously, it stops being a website glitch or a seasonal issue. It starts looking systemic. Then there's Costco. Yes, the bulk retailer. When a store famous for selling in huge quantities starts placing limits on bullion purchases, it's telling you demand is overwhelming their restock cycle. Why would a warehouse club ration a product unless the pipeline is tight? Now we get to the data point that should make you sit up straight. China. I'm looking at Shanghai Futures Exchange Vault figures dated today, January 30th. Total reported stock sits around 455 metric tons, about 14.6 million ounces. That sounds gigantic until you compare it to global yearly demand north of 1 billion ounces. Then it becomes tiny, barely a sliver. Here's the shock. In a single day, roughly 26.9 metric tons were withdrawn. close to 870,000 ounces in 24 hours. At that pace, those vaults would be drained in weeks, not years. And here's another layer. China has been treating silver more like a strategic material, tightening exports, shifting it into the category of we might need this. So if exports are restrained and local withdrawals accelerate, what does that imply? Someone wants physical inside the country, not paper claims outside it. Do they know something about future supply, future demand, or future settlement risk? Now, let's identify who's doing the heavy selling that crushed the quote. Watch the timing. The aggressive dumps largely occur during U.S. trading hours. New York opens, price gets hit. New York closes, selling pressure eases, Asia trades, stabilization, or even recovery. Then the cycle repeats when U.S. hours return. Does that pattern look organic to you, or does it look like a machine turning on at a certain time each day? Here's the practical translation. In the West, large players can flood the paper arena with synthetic supply, contracts and derivatives at a keystroke. That can knock the quote down quickly. Meanwhile, in parts of Asia and the Middle East, buyers focus on taking delivery, actual bars moving into private storage. One side plays with claims, the other side accumulates scarce inventory. Which side is behaving like they believe the metal matters? This pattern isn't brand new, but the intensity is, and the strain signals are flashing. One of the loudest signals is the silver lease rate, the cost to borrow physical metal. In calm times, it's low. When lease rates spike into the high single digits or far beyond, it's the market saying real metal is hard to source and lenders demand a premium to part with it even temporarily. Some quotes have shown extreme prints, numbers that feel absurd, but absurd is what scarcity looks like when everyone needs the same thing at once. Now connect the dots. Mints pausing intake, dealers failing deliveries, vaults being drained, lease rates spiking, and a paper quote that falls like nothing is wrong. That combination screams one conclusion. The paper pricing mechanism is losing contact with physical conditions. For decades, paper volume has been so huge, it could steer the visible price, even if the physical market was tight. But the physical side has limits. It can't be printed. It can't be conjured. When physical demand overwhelms available supply, eventually something must adjust. Either the quote rises to meet reality, or settlement and availability keep fracturing. So what does this mean for you? First, if you own physical silver and you're tempted to panic sell because the screen is red, slow down. Look around. Rationing, delays, suspended sales, delivery failures. Those aren't signals of a worthless asset. Those are signals of a stressed supply chain. Screens can fall, shortages don't fake themselves. Second, if your exposure is mainly paper, ETFs, unallocated accounts, futures, ask a blunt question. If everyone demanded delivery at once, would your claim convert cleanly into metal on time without exceptions? Or do you own a promise that works until it doesn't? Promises are only as good as the inventory behind them. Third, if you're trying to buy now, you already know the punchline. Premiums are jumping in many regions. The quoted spot number may say one thing, while the street price for actual metal says another. In some markets, the premium is so large it looks unreal, until you realize you're not paying for silver alone. You're paying for immediacy, certainty, and delivery. Here's the paradox that confuses people. The harder the paper quote drops, the faster real inventory can vanish. Lower quotes trigger bargain hunting drains stock raises premiums, higher premiums widen the gap, and the dislocation becomes self-reinforcing. It's a feedback loop. The crash can worsen the shortage, not relieve it. Some will call this a conspiracy. They'll say, relax, it's just temporary. Or, mints always have issues. But look at the pattern across regions. Australia pauses wholesale intake, US sales disruptions and repricing, the UK short on bars, India showing delivery failures, Costco limits, Shanghai vault withdrawals, lease rates surging. That's not one isolated hiccup, that's a chorus. Let's talk about timing, because timing is never neutral. Today is the last trading day of the week and the month. Month end often brings settlement games, options pressure, position squaring, and forced moves. Big players like to strike when liquidity and psychology align. Late Friday, end of month, maximum emotion. Shake people out, trigger stops, harvest fear, zoom out further. This didn't start this week. Silver has been running structural deficits for years, multiple consecutive years where global demand outpaced mine supply. Each year, the difference has to be filled by above-ground stockpiles, vault inventories, recycled metal, old reserves. Picture a reservoir where withdrawals exceed inflows year after year. Eventually, the buffer shrinks. And when the buffer shrinks, any demand spike becomes a crisis, not a blip. That's why the vault numbers matter. That's why mint pauses matter. That's why defaults matter. They're symptoms of a system that has been drawn down for too long, now hit with a wave of buying. You can ignore a deficit on paper for years, until the warehouse is empty. So what happens next? I can't hand you certainty. But I can outline the likely path. The paper quote may keep swinging wildly, down, up, sideways, because paper can be traded in enormous size with minimal friction. But physical availability can keep tightening. Premiums can keep rising. Delivery windows can stretch. The separation between screen price and real-world cost to acquire can widen. Eventually, you reach a point where the posted quote feels like a reference number, not a purchase price. We've seen echoes of this in history. During past squeezes and scarcity events, dealers ran dry, spreads blew out, and the paper signal lagged the physical scramble. I'm not claiming a perfect repeat. Today's rules, players, and guardrails are different. But one principle doesn't change. When too many claims chase too few ounces, the ounces set the terms. Real assets don't negotiate with fantasies. Right now, there are three kinds of viewers. The first is frightened by the drop and wants out. The second is stuck between conflicting signals and does nothing. The third understands the structure. Paper can be dumped quickly, but physical conditions reveal scarcity. Which one are you going to be when the dust settles? Let me summarize the contradiction in plain language. This week, the visible quote fell hard. In that same window, major mints restricted supply, retailers limited purchases, dealers struggled to deliver, vaults saw heavy withdrawals, and borrowing costs for real metal spiked. The number on a screen said cheaper. The real world said harder to get. One of those messages is misleading, so don't let the red candles hypnotize you. Pay attention to availability, delivery, and premiums, because those are the heartbeat of the physical market. If you found this breakdown useful, please hit like and subscribe to Vantage Economics, because I'll keep tracking this disconnect as it develops. And tell me in the comments, do you think paper pricing can hold, or does physical scarcity eventually take control? Remember, when the quote falls and the shelves empty, you're not watching a free market. You're watching a performance. And once you see the stagecraft, you stop being the audience.